Welcome to the X Project Podcast. This is a podcast of the X Project Substack. To subscribe, please go to thexproject.substack.com. A powerful and unappreciated structural force driving our markets is about to change. A summary of Mike Green's views on passive investing. Article number 39, published March 3rd, 2024. First, a note for podcast listeners. This article contains a couple of important charts towards the end of the article. If you are not driving, you may want to open the article to scroll through to the charts to view while you listen. Again, only if it is safe for you to do so. In this article, the X Project will answer these questions. Section 1, why this article now? Section 2, who is Mike Green? Section 3, where is this perspective coming from? Sections 4 through 8, what are the top 5 takeaways from this perspective? Section 9, what does the X Project guy have to say? And, as always, Section 10, why should you care? Reminder for readers and listeners. Nothing the X Project writes or says should be considered investment advice or recommendations to buy or sell securities or investment products. Everything written and said is for informational purposes only, and you should do your own research and due diligence. It would be best to discuss with an investment advisor before making any investments or changes to your investments based on any information provided by the X Project. Section 1. Why this article now? The current financial landscape is marked by historic levels of passive investment, influencing stock valuations and market movements in ways that are not fully understood or appreciated. Understanding these impacts is crucial for both individual investors and policymakers. As passive investing continues to dominate, the need for a critical examination of its long-term effects on market stability, asset pricing, and investment strategies becomes more pressing. Given the lack of recent market volatility and debates around the sustainability of passive investing during downturns, this article offers timely insights into potential risks and challenges that could shape future market behavior and investment practices. Mike Green's perspective on passive investing is multifaceted and deeply analytical, touching on the systemic risks and market dynamics influenced by the growth of passive investment strategies. He argues that the massive influx of funds into passive vehicles, such as index funds and ETFs, driven by their rule-based buying and selling strategies, fundamentally alters market behaviors and price discovery mechanisms. Green points out that the theoretical foundation of passive investing assumes these investors never transact. Yet, in reality, transactions are constant through their regular inflows, challenging the very definition of passive investing. This, he suggests, has led to distortions in market valuations, potentially making markets more vulnerable to shocks as passive investments market share grows but will likely reverse at some point soon. Section 2. Who is Mike Green? Mike Green is portfolio manager at Simplify Asset Management, and according to their website, quote, Michael has been a student of markets and market structures for nearly 30 years. His proprietary research into the shift from actively managed portfolios and investment funds to systematic passive investment strategies has been presented to the Federal Reserve, the Bank of International Settlements, the International Monetary Fund, and numerous other industry groups and associations. Michael joined Simplify in April 2021 after serving as chief strategist and portfolio manager for Logica Capital Advisors LLC. Prior to Logica, Michael managed macro strategies at Thiel Macro LLC, an investment firm that manages the personal capital of Peter Thiel. Prior to Thiel, Michael founded Ice Farm Capital, a discretionary global macro hedge fund seeded by Soros Fund Management. From 2006 to 2014, Michael founded and managed the New York office of Canyon Capital Advisors, a $23 billion multi-strategy hedge fund based in Los Angeles, California, where he established their global macro strategies, managing in excess of $5 billion of exposure across equity, credit, FX, commodity, and derivatives markets. In addition to his work as market theorist and portfolio manager, Michael has been noted for his work as a public speaker and financial media participant. He is a graduate of the Wharton School at the University of Pennsylvania and a CFA holder. End quote. Mike Green is active on X Twitter and can be found at ProfPlum99, and he is also on Substack as Professor Plum and writes, "Yes, I give a fig. Thoughts on markets from Michael Green." Section 3. Where is this perspective coming from? Mike is a frequent guest on various YouTube channels, and this article summarizes his views based primarily on the following recent interviews. First, the driving force behind modern market dynamics with Michael Green. 4,217 views and published on October 7th, 2023. Second, Simplify's Mike Green talks Powell, geopolitics, and the problems posed by passive investing. 1,506 views, premiered February 8th, 2024. Third, passive capital flows are starting to reverse. This will change everything. 71,603 views, premiered February 13th, 2024. Fourth, has passive investing broken the market? 4,845 views, published February 22nd, 2024. And fifth, economic time bomb, the silent threat of passive investing exposed. 14,851 views, premiered February 28th, 2024. Section 4. What is the top takeaway from his perspective? Risk of market distortions. Mike Green emphasizes the significant market distortions that can arise from the disproportionate influence of passive investing. He argues that passive investment strategies, which operate on simple algorithms like, if you give me cash, then buy. If you ask for cash, then sell, fundamentally alter the market's natural behavior. This process lacks consideration for the underlying value of assets, leading to an inflationary dynamic within markets. Green highlights that passive investing's market share growth creates distortions, not just through direct investments, but also through mechanisms like securities lending operations, where the real money is made. This contributes to an environment where markets are increasingly disconnected from economic fundamentals, leading to potential systemic risks. Section 5. What is another top takeaway? Impact on price discovery. The dominance of passive investing impairs the market's price discovery mechanism. Green points out that the theoretical foundation of passive investing relies on investors never transacting, which is far from reality. Every paycheck invested through a passive vehicle results in a transaction, contradicting the notion of passivity. This process, driven by constant fund inflows to passive vehicles, divorces the buying and selling of stocks from their intrinsic values and market fundamentals. It leads to a situation where market prices are more a reflection of capital flows into passive funds than a true measure of companies' worth, undermining the market's ability to signal economic health accurately. Section 6. What is a third takeaway? Vulnerability to large withdrawals. Green discusses how the market's increasing reliance on passive investments heightens its vulnerability to large withdrawals. With passive investments constituting a significant market share, any substantial shift in investor behavior, such as mass redemptions to fund retirements, could lead to dramatic market downturns. He draws parallels to historical bear markets in other countries, suggesting that similar prolonged downturns could occur in the US if negative flows become dominant. This scenario underscores the systemic risk posed by the sheer scale of passive investments in the market. Section 7. What is a fourth takeaway? Challenge to active management. The growth of passive investing presents a formidable challenge to traditional active management. Green argues that the efficiency and simplicity of passive investing, which often results in lower fees and better performance relative to a large portion of actively managed funds, have led to a significant shift in capital towards passive vehicles. This shift not only reduces the diversity of investment strategies, but also puts pressure on active managers to justify their existence. The homogenization of investment strategies, driven by the dominance of passive investing, could amplify market movements during periods of stress, further exacerbating volatility and systemic risks. Section 8. What is a fifth takeaway? Demographic pressures and outflows. Finally, Green delves into the potential impact of demographic shifts, particularly the retirement of baby boomers, on passive investments. He warns that as this demographic begins to withdraw investments to fund retirements, the balance of inflows and outflows could shift negatively, applying downward pressure on markets. This situation is exacerbated by the structure of passive investing, which necessitates selling assets to meet redemption requests, potentially leading to a self-reinforcing cycle of market declines. Section 9. What does the X Project guy have to say? First, I have known of and followed Mike Green and his work for years. Demographics is one of the 10 subjects the X Project studies. Mike Green identified a direct link between U.S. demographics and the U.S. financial markets via the baby boomer demographic bulge and passive investing. And so it was the third interview above that prompted this article. If you are going to listen and watch just one of the YouTube videos, watch the third one listed above, which is Adam Taggart's interview on his Thoughtful Money channel. And if you don't have time to watch the entire 1 hour and 18-minute interview, skip ahead 53 minutes and 45 seconds and start watching there. Green starts by talking about the problem with the poor quality of employment data coming out of the Bureau of Labor Statistics and how misleading initial releases of monthly reports are when they are eventually revised and end up being much lower than originally thought. However, he then goes on to his most important point, which is that the passive investment flows are starting to slow and turn negative. He shares this chart. The Vanguard Total Market Index adjusted price shares outstanding for mutual funds and ETFs. He points out that the 401k plans almost entirely flow through mutual funds, and those flows are starting to turn negative due to baby boomers retiring. Instead of contributing to their plans and adding to the passive flows, retirees have now stopped contributing to their plans and starting to take withdrawals. He also indicates that mutual fund outflows have been up until recently, offset by ETF inflows, which are not usually part of 401k plans. And then he shows this chart, which combines the mutual funds with ETFs. He states that unlike in early 2020, due to the pandemic, the slowing and decline we are now seeing is the structural change taking place demographically, which throws the positive passive flows into reverse. Changing one of the major tailwinds supporting the market into a major headwind can be catastrophic for the market going forward. Having said that, Green points out that policymakers are aware and references 2018 when we started seeing the same phenomenon. What happened then? Policymakers increased the amounts able to be contributed and extended the age at which distributions must start. This just delayed the inevitable, but it showed that policymakers will try to avert the disastrous decline in the stock market that might otherwise occur. Note, if you have not read Why Rate Cuts, a Lower US Dollar, and Inflation Will All Be Returning Soon, Revisiting Fiscal Dominance and the US Policymakers' Only Choice, article number 37, you should do so, as Section 6 in that article explains why U.S. policymakers need higher stock markets. Don't policymakers realize the inevitable has simply been delayed? Probably, and that is why Green suggests we will likely hear proposals soon, or at least lobbying by Vanguard, BlackRock, and other major players providing passive investment vehicles, for proposals like the US government should simply hand out $10,000 to every person to invest and save in the stock market. In the next section, I will explain further why you should care and, more importantly, what you can do about it. However, the X Project now requires you to view the final section as a paid subscriber. In a few articles, the paywall will move up within the article so that only paid subscribers will see the last 2 sections, or rather, free subscribers will only see the first 8 sections. I will be moving the paywall up every few weeks, so ultimately free subscribers will only see the first 4 or 5 sections of each article. Please consider a paid subscription. All paid subscriptions come with a free 14-day trial, and you can cancel anytime. Every month, for the cost of just 2 cups of coffee, the X Project will deliver 2 articles per week, helping you know in 1 to 2 hours of your time per month what you need to know about our changing world at the intersection of commodities, demographics, economics, energy, geopolitics, government debt and deficits, interest rates, markets, and money. You can also earn free paid subscription months by referring your friends. If your referrals sign up for a free subscription, you get 1 month of a free paid subscription for 1 referral, 6 months of a free paid subscription for 3 referrals, and 12 months of free paid subscription for just 5 referrals. So please, refer your friends. Thank you. This concludes the X Project's podcast number 39. Please subscribe to the X Project Substack at thexproject.substack.com.